first idea is a bet against bonds. This is a bet. Is this a bet that interest rates are going up from here, or long-term yields?
Yeah, bond prices are the same thing. Yeah. Yields are going to rise because prices will fall, and you'll keep getting a higher rate. This one's a really, a fantastic portfolio hedge, even for someone who's got an all-equity portfolio. Certainly the 60-40 sort of portfolio that we're talking about, we're of the view that that's got some trouble. The equity part is much more higher potential than the 40 part. So this one's a bet against yields that they're going to rise, and you're going to profit from this.
So it's an ETF, TBT in New York. Okay. And part of your point here is this long-term decline in bond yields, and you think we're in a reversal now, a decisive reversal?
Yeah, that end there is a reversal. We haven't seen that, Andy, in 40 years. Now, it doesn't mean we're traveling the full road back to 14% by any means.
Whoa, that'll be a shock. Yeah.
We are not projecting that. As technical analysts, we do fundamental analysis, and we marry them all together. You just know it's going in a direction, and that's the direction it's going in. So, we don't try to time it, but this unit benefits from that. We've seen that in, off the top, where yields went from 0.4% all the way up to 4.2, yields corrected down to 3.2, and now we're at 3.7%, and there's that unit right there. This is when we became quite interested. Certainly a break above that $32 will sort of bring in $38. And so if you needed some protection, you're a real equity investor, this would actually be a pretty good time to pick this up. Your risk is pretty minimal. There we go. Your risk is pretty minimal. And this actually is a sort of a type of pennant, goes through there, and that's how we get to that sort of $40. This would be a position that you would, again, be you'd be temperate with how much you commit to that, but this is really a hedge on your portfolio.
Okay, I think we had a percentage sign there, but it should have been a dollar figure on the right vertical scale. Okay, Monster Beverage, MNST.
Yeah, this name is it's technically strong. It's got a really good line in the sand, and I use the euphemism, hang your hat. And so if we're entering a position, where would we go to hang it up? That was a split. The stock did not do that. But the place we'd hang our hat is sort of around $52, meaning if you entered this position and you were sort of wrong, your downside is quite limited. The whole space is really quite attractive. Monster has enjoyed 60% margins domestically in North America, but only 34% internationally. And that's where all the sales are really ramping up. So they're sort of getting used to how to doing business overseas. And part of that's getting, better deals on packaging and cans and all that kind of stuff. So tons of upside. If you didn't like that, you can look at Molson Coors in the space. You can also look at the whole beverage ETF, PBJ, a good unit to have as well if you didn't want to get specific. The whole sector is pretty good.
Okay. And then your final idea here is DEFINITY Financial, which is an insurance company.
Yeah. These guys, you might know them from Sonnet on TV. They also own Economical in Waterloo, Kitchener Waterloo, where I live. These guys are new. Their story isn't quite well known. You can see it's a little bit of a choppy chart there, but the swings aren't that big. This would be one that I would definitely buy long term. Next year, they're going to have some increases to their bottom line. Their combined ratio, meaning how much they spend, was over 100%, which means you're not making money. They've got investment income that doesn't get factored into that, but they've got a bunch of things that they're doing that will sort of hit the bottom line next year. And this would be one that, as a demutualization goes, you tend to do quite well over the long term with this. Has less impact on the markets, how it does. A lot of insurance companies are impacted by markets. This one's a little bit less than some of the bigger names that we know, Manulife, for example. But this would be a good long-term hold. Some of the other names we talked about, too, were a bit more a trade. This is definitely a long-term hold that you could step into today.
Let's just put up that monster chart again, if we could, very quickly, a one-year chart, because the stock did split there at the end of March, and I think that threw our chart off.
Yeah, I know. It throws
apologies to viewers there. We should have adjusted that one. Yeah.
Well, it's my software will still do that too. I think it's a ghost in the machine. You can't get it perfect. But yeah, it did not drop like that. It split. This is well loved on a generational basis. The millennials and Gen Zs, any product that comes out of the company looks pretty good.
Yeah, our software does too, but sometimes things slip through. Yeah. Hap, always great to talk to you. Thanks very much indeed. Hap Snedden. Let's get to those top picks. Number one, Tricon Residential, TCN. Can you remind me, they're mostly in the States?
So Tricon's Canadian and with some exposure to the States.
Oh, okay, but they have stuff here as well in Canada.
Exactly.
Okay.
So this is basically residential rental property management, Andy, at the end of the day, not construction.
Oh, okay.
But basically a company that just acquires more and more rentals as we go forward. And, this gets back to our thesis on Canadian apartment REIT. If we think rental demand is going to keep increasing, and as you know, we've got a massive shortage in Canada of rental units, that is only going to get worse as we bring in more people into the country. So companies like this, I think, are poised to do better. The stock right now is trading very cheaply, in our opinion. Estimates on the street, have maybe a $2 rally. I think you've got $12, $13 estimates up there. I think we can do better than that over the next year. So we've now started to move into this stock just on that rental thesis.
Yeah, it's interesting. I mean, there is going to be political heat over money going into buying up existing rental properties as opposed to actually building new ones.
Yeah, but I think at the end of the day, it's if you want to solve the problem, you're going to need companies that are willing to take the risk to acquire those properties and run management. Off air, we were talking about what was going on in Florida with respect to the storms and insurance companies. Well, Florida right now is one of the few states that has a positive net migration. So people are flooding into Florida to do business, to live. And guess where Tricon is focusing its efforts right now? It's in Florida on the Sun Belt. So I think you're going to see a lot of demand and growth on this stock going forward.
Nutrien is your pick. We got a story just today that they've Campotex, the Canadian export potash cartel, is supplying the Chinese with potash at the lowest price since early 2022.
Yeah. So this is a company we still own in the portfolio. We had reduced exposure to this quite a while ago. The share price has been dismal this year. And this would be in our speculative camp of positions that we want to start adding to just based on valuation. And it's been a very rough ride for Nutrien. If you look at potash prices, if you look at urea prices in the last few months, both of which have a huge impact on the valuation of Nutrien, have gone in the wrong direction. That being said, Andy, if we look at Brazil, for example, potash prices appear to be stabilizing somewhat. If you look at the urea futures or near-term futures in the market, signs of stability there. So we think that on an evaluation basis, we like the stock. It is a higher risk stock. It's a highly speculative stock at this point. But I think this is an opportunity to start adding exposure at these cheaper levels.
Okay. Scotia says the real focus, their focus is the U.S. corn crop. There's a drought there. And apparently a lot of the fertilizer has gone on to that crop. But this could push up corn prices, which would be good for the next planting and good for fertilizer.
You're going to see this in wheat, Andy. Take a look at Africa right now, drought conditions in Africa.
Australia.
El Nino in Australia. I mean, wheat futures are going to rally, corn futures. And to your point, that does two things. One, if the price of my product is going up, I've got more profitability I can afford to spend on fertilizer. But you're absolutely right. They have to replant in a lot of areas. So part of the positive view of this stock going forward.
Yeah, I was looking at a map in Iowa, Indiana, the real sweet spots for corn, very dry. TD Bank, under a cloud after their takeover of First Horizon fell apart.
Yeah, and rightly so. There's no reason why you should buy a company with that valuation versus where it's valued today. And I think, and I'll say this for a lot of the banks in Canada, there was a disproportionate response in share prices in this country to what was going on in the States. And this is typical. We saw this in the financial crisis. When banks lost 50% of their value, we didn't have a housing crisis in Canada. And we don't have a deposit crisis in this country. We're so far from that, it's not funny. So in our opinion, we're looking for banks in Canada that are obviously rock solid dividends, and just have valuations now that make absolutely no sense. We had an earnings season that wasn't fantastic for the sector as a whole. But I think if you look at a lot of things with TD, whether it's provisions for loan losses, not as great as what people thought. Capitalization is great. We think the dividend is safe, obviously. So we're now looking to take advantage of these depressed valuations to add to what we already had in the portfolio.
Oh, okay. You feel people will be kicking themselves they didn't pick up TD at these prices?
I think they will, right? If you look at TD right now, it's the worst performing bank stock on the TSX since the beginning of the year. And you've got to look at why is that the case, right? And if the fundamentals don't match the share price movement over the last 6 months, then that's usually a good opportunity to step in. It's not to say it's risk-free. If we get a heavy recession in Canada, bank stocks will not do great. But at this stage, I think we're convinced that this sector offers stability that other sectors around the world do not.
Yeah, I'm showing TD down 11% this year, and the banks group, just not the financial index, but the banks group down about 4%. So it really has lagged.
Yeah, almost triple the downside performance, which it really doesn't make any sense for us at this point.
Right. We better leave it there, and thanks very much.
My pleasure, Andy. Always good to be here.
Andrew Pyle. First idea, analog devices. Are they semiconductors or analog chips? Yeah.
So like in the world of semiconductors, you have analog, which is sort of the programmed, and then there's the digital and memory side that you can configure, right? And so analog devices does analog.
Yeah.
And actually, I should have mentioned it to Peter, because when Peter was talking about AMD, if you're still listening, Peter, when you trim a little bit off of AMD, I'd recommend that you pick up analog. You're still in the semiconductor, but you're moving from the digital over into the analog side. So the company basically provides like converter products and analog signals, and power conversion, driver monitoring, and so on. It's all the chips that go into our refrigerators or our sewing machines or whatever, to get them to constantly do what they do repetitively. It's a pretty crowded space. These guys not only design, but they also manufacture. But you have people in there like STM Microelectronics, Texas Instruments is involved in the analog space. But the reason I picked this is that you've seen sort of the NVIDIAs of the world just go up to ridiculous price-earning multiples. And if you still want to participate, and you should participate in the semiconductor, just rotate. Take a little bit of money off of the digital side and put it over into the analog, like an Analog Devices or a Texas Instruments. Currently trading at about just over 170. 12-month price target of 212. So it's still got a decent runway.
Okay. DELL Technologies. You like the look of this one?
Yeah, a lot of people are probably thinking I'm being a little bit chicken, but it is conservative. When you look at a lot of the semi side, the software as a service, they've had a great run. They're getting close to their price target. And this is where we start to trim some stuff and get into more conservative things. We don't know whether you're going to have a recession sort of in late third quarter, fourth quarter of this year. DELL Technologies is a great place, but I'm sure a lot of people say, well, hold on. They're involved in personal computers. Well, yes, and actually, the desktop, workstation, notebooks, they have had a bit of a haircut and slowing growth. But the other side of the coin, which actually is it's more like around 65% of Dell's business is into data centers. So this is actually even a play into that sort of generative AI, because what you need for generative AI is data, and what you need are cloud systems, and the cloud systems sit in the data centers. And Dell is one of the biggest suppliers, for the racks that they have in the data centers. So it's a nice play. It's currently trading right around $45, and it's got a 12-month price target of $55. And it's a big company, and if I recall correctly, I think they have about a 2.9% dividend yield.
Okay. Right, that's interesting. A lot of people would have thought, they're just PCs, but you say big in the server farms. Yeah.
Exactly, and you need the data centers to do all the AI stuff.
I'm showing a yield. Actually, I'm showing a yield of just over 3%.
Yeah.
And then finally, Monday.com. This is one of these productivity software companies.
Right, work collaboration. And we've talked about these before. Names like Asana. We actually use Asana. We started to look at Monday because we've started to grow sort of the Asana. The other one, the other big player in the work collaboration space is that Australian firm Atlassian, symbol team. But Monday.com is an Israeli company, and one of our senior analyst, Alex, lives and works over in Israel, and he knows these guys inside and out. One of their claim to fame for Monday.com is that they have low-code or almost no-code technology, and it's a big differentiator. So you don't have to be a technology whiz. A lot of what they do in the work collaboration, work management tool space is intuitively built into their software. So it sort of leads you. Which is nice, and you know they reported back on May 15th. They're still unprofitable. However, it was a big deal on May 15th when they came out and they said, you know what, we're going to be profitable by the fourth quarter of this year. When they were actually talking, even last year, that it was going to be 2025, and so it's had a nice run here. It's currently trading, I think, right around 183, 184. We have a 12-month price target on Monday.com of 226.25. So if you want to know anything else, just give us a shout at Black Swan.
Okay, and they can just look you up, Black Swan Dextertas, on the web.
Yep.
Okay, well, let's leave it there. Thank you very much indeed, Ken.
Yeah, great to be with you.
Always great to hear. We always learn a lot about tech. Ross's first idea is Laurentian Bank.
Okay, Andy, I'm going to sort of back up a little bit. I'm going to say, permit me to observe that my top picks are what I would call quality defensive stocks and may not align with my immediate market outlook. Okay, which is for maybe a potential explosion in in the high techs. But
when you say explosion, going down,
up.
Oh, up! You think?
No. I think the AI. I think the AI stocks, Andy,
could be a melt up from
here. I think they've got miles to go. They're just like the .coms. Okay, and the same uncertain nature of the whole things, and the same potential open-ended value that they appear to appear to offer. Mostly, they will be drastically disappointed, of course.
At some point. Okay.
But right now, we're in the emerging phase.
No problem.
However, I'm not going to be there for my top picks because I have to come back in a year from now. Because heavens knows what will happen by the end of that year and give some value. So, Laurentian Bank, nice 6% yield, okay? Huge upside potential as we measure it. And it's trading at a valuation level which is tied for its all-time low. In other words, if you don't buy it here, when are you going to buy it? Furthermore, their new CEO has been dedicated to improving the profitability and the outlook for the company, and she's doing, I think, everything she can to do that. If there isn't, I'm not sure that they just announced an increase in their dividend, but
let me check.
She cut it, and I think a rebound is very definitely. Should be in the offing from there. This is one of these stocks. If you don't buy it at a dead bottom and a very, very long-term low, where on earth are you ever going to do it?
So the dividend was cut in 2020, and my Bloomberg is showing that they did just increase it, Ross. It was 67 prior to the cut, and it's now gone up, according to my Bloomberg data, gone up 1 cent to 47 cents. So they have partially made
partially, Andy, or you're not going to get rich on 1 cent.
No.
But she certainly has more room to go there, and they say stock very, very, very cheap.
Suncor would be among your favorite energy names right now.
Good upside potential, nice yield, strong balance sheet. And as we are finding out, oil demand isn't going away, even as the ESG crowd tries to shut it down, making oil availability more difficult. Furthermore, by the way, with the expanded Trans Mountain pipeline coming on stream shortly, the spread between West Texas Intermediate and Canadian oil prices is closing, and that has to be bullish for the Canadian oil companies. So if we get a decent company with good upside, a nice yield, and improving prospects, I think we've got to go there, Andy.
Okay, and then finally, Hudbay Minerals would be one of your favorite plays on copper.
Well, yeah. Here's the thing, you know, with all these electric vehicles and with again that ESG demand for, you know, cut out fossil fuels and get alternate forms of power. Electricity comes into its own, and when you got electricity, you got to have a way of moving it around, and that's copper. Well, what's happening to the copper market? Well, Chile is having all kinds of problems with its own output, and depletion is cutting in. The copper market is a mess. With demand picking up and supply under pressure. Well, that's the kind of confluence of events that you really like to see. And then if you can buy a stock that's cheap, okay, on top of everything else, from a historical point of view, is cheap and has good upside potential currently, then it's trading at a 30% discount to book value. This is the kind of thing where if I'm wrong in the next few months, I'm not going to worry about it because I'm going to be right in the end, and probably right in a major way.
You had thoughts there on United Healthcare. We didn't spend very much time on
Yes, I had a question on, the gentleman asked me about Centene and United Healthcare, and I only answered the Centene part. To that gentleman, I would say, look buy Centene. United Healthcare is trading way up at its fair market value.
UNH.
UNH, yes. And that tends to, although it's been a little bit above there recently and pulled back, normally that's about it for the stock. And so I really can't see much more for the stock there. Whereas with Centene, I can see a lot of upside.
I just want to circle back very quickly. We don't need to show that chart we looked at the top again, the top of the show, but Enbridge. Now, I think I got mixed up here. So your argument is not necessarily that Enbridge is undervalued. You're cautious on the stock, or just remind us?
Yes, I'm cautious on the stock because when I see a stock kind of reaching up to one of our to fair market value for one thing, and one of our very, very strong actually technical breakpoints, then I usually expect a fair setback, and that has been the history with Enbridge in the last 5 years. So I think it's a little bit too early now to be in there. Watch it because it's coming down, but watch it.
Okay, so Enbridge not calling out to you right now. Ross, thank you very much indeed.
Okay.
First idea is a big name in copper, Freeport-McMoRan.
Yeah, one of the biggest. They provide about 8% of the copper demand in the world.
Wow.
And they have reserves for 12 times that. So 8% translates into about 3.2 billion pounds of copper, and they have reserves for over 100 billion. It's expected that by 2035, copper demand will grow at about a 6% rate. So a very fast clip, about doubling the demand for copper by 2035. And the story is well known. Copper is the new oil. It's going to be used in electrification, which is going to power everything from cars to electrical grids, and that's where we're moving. And the cyclicality, though, of copper has been seen over the last few months. China is sputtering. We've had a war in the Ukraine. We're worried about a global recession. High interest rates are a headwind, and copper prices haven't done that well. The stock hasn't done that well. And here's going back to what I was talking to other viewers about, is where you have to exercise patience and understand the long-term story. Buy quality. Don't worry about the gyrations on a day-to-day, week-to-week, month-to-month basis. Keep your eye on the horizon. We think that Freeport will do extremely well over the long term. They're cash rich, very strong balance sheet, good capital allocation program. They pay a fine dividend. So just buy it, hold it, and wait for the high when there are tailwinds as opposed to headwinds, and consider an exit or a partial exit at that point.
Would you prefer it over tech, for example, or is there too much noise around tech with the potential takeover, for example?
Yeah, I don't look at tech specifically, Andy, because it's a Canadian-based company. But, at Goodread, we do manage in Canada, and I know Rob Gill looks at the Canadian opportunities. We don't own tech at this point, but the next time that Rob is on,
we'll ask him about that.
Ask him about tech, for sure.
Good.
For sure.
Merck is one of your favorite pharmas right now.
It is. I talked about Pfizer. In fact, I talked about two Pfizers earlier, and Merck is a great franchise. The pharmas have been held down. It trades at about 14, 15 times earnings. AAA balance sheet, growing at about twice GDP, so somewhere around the 5 to 6% annual rate. Pays a good dividend, lots of coverage on that dividend. You always have to look at coverage when you see a good dividend, a higher dividend. How much of the earnings are going to service that dividend? You generally like to see a number below 50%. Now, dividends technically don't come out of earnings. They come out of retained earnings, but that's a bit of a technicality. But you don't want to flow all of your profits back into just dividends. There should be a healthy debate on where that capital goes. Should it go to pay down debt? Should it go to dividends? Should it go to stock buybacks? Or perhaps very importantly, should it go to new initiatives, new projects, growing the business internally? And you should always look for that as an investor.
And finally, Toll Brothers, the house building company, isn't there going to be a cloud over it with mortgage rates much higher than they were?
Interestingly, no.
And the stock's up,
Stock is up, and the reason the stock is up is that in the United States, mortgages tend to be longer term duration than here in Canada. So people can buy 30-year mortgages and so on. And in the near zero era that we went through, anybody who had any type of high interest rate mortgage refinanced at a much lower rate. So they locked in 2-3% for many years. So they're sitting there now with a house and they're thinking, well, should we put our house up for sale and move down the street? Well, we'd have to get a new mortgage. You can't port your mortgage in the United States. So we'd have to get a new mortgage at a much higher rate. So that's taken the resale market and dampened it. So there's just not a lot of supply on the market, which forces buyers into the new home market, which brings us to Toll and the other home builders. They're busy as can be because of that, and they manage their businesses extremely well. It's trading at about 7 times earnings, trading at about 1.1 times book, good on an absolute basis and good against its peers, always do peer analysis. So we very much like Toll.
That's interesting. People trapped by their current low-rate mortgages.
Yes.
Yeah. It is funny how they take these multi-decade-long mortgages, and they're not really a thing in Canada.
No, it's a completely different environment.
Gordon, thank you very much indeed.